Hi folks, welcome to an introduction to budgeting for small charities. We are going to be looking in this brief slide deck at a way to do a really simple budget for a small charity with a couple of restricted grants, how to capture the full costs and give us our best chance of full cost recovery when we're fundraising. The upsides of budgeting for restricted and unrestricted income separately, and some practical tips for tracking budget performance and adjusting for changes. Going back to first principles, what is a budget? Well, it's a tool, it's a practical tool that we use to allocate resources and really support the delivery of what we're trying to do. And a really good budget is not only going to tell us how we're whether we're going to get over the line, but it also identifies financial problems that might arise in the year, and it gives us, if we structure it well, it will tell us how close we are getting to financial sustainability, and when we can't, critically what the gap is, because the gap between what we need to do and what we can do is risk, and if we can identify that and manage it, that's where resilience sits, in that gap. So yeah, it helps with planning, it helps with fundraising, it helps with decision making, and it really can help to keep us sustainable over the longer term. And ultimately, all we're trying to do is keep going so that we can keep making people's lives better and communities stronger. And anything that helps us do that is a win. And I think a budget is a really good win. I think it's something to celebrate. And so it's just a plan. It's your organisational plan in numbers, looking at income, looking at expenditure. And in the same way that most people wouldn't go up a mountain without a plan, we probably can't survive very long as a charity without a financial plan. We can get lucky and get a bit of momentum for a while, but after a while you really do need to know what's going on in the weeds, and that's what a budget's going to do. A sustainable budget is going to show our whole organisation for a whole year, broken down into separate grant activities, with each activity costed fully and with unrestricted funds very clear, and generating a surplus to build and maintain reserves. That's what sustainability is. Not many of us, frankly, can do that. That's okay. Let's know what we can do and manage the risk when we can't. So we're going to start with the template. Let's not reinvent the wheel. It's a tale as old as time. Use a conventional template, customizing income and expenditure categories. Create the columns for each grant activity. Start with the worst case, then move to the best case, and review. And some organisations will use the columns for grants, which is probably the simplest way, folks. You can use them for activities or funds. That's probably outside of this brief slide deck and this Small Charity Finance Foundations programme. So the upside of using the conventions is that if you have a conventional budget, bookkeeping system and annual accounting system, it is going to stick together like honeycomb. And I see lots of intuitive systems that work very well for a long time, but after a while, I think we all need to move to the conventions. And a convention isn't really that complicated. It's income, expenditure, surplus, deficit, don't forget brackets mean negative, opening funds, also known as our funds brought forward from last year, and then closing balances, which are our funds carried forward to next year. And so this is a conventional layout. The income is new income earned in the year, so don't confuse that with the funds brought forward from last year. If you had income last year and you didn't spend it all, it is not new income this year. It is an opening balance. Keep them separate. So income is new income earned in the year. Expenditure are new costs that we're going to incur this year. The surplus deficit is the difference between the two, and you might sometimes see this referred to as net income and net expenditure. That's accounting speak for surplus and deficit. which is charity speak for profit and loss. So don't worry too much about the jargon. Let common sense prevail. Income, expenditure, then the difference between the two. Then our opening balance, this is what we start the year with, and our closing balance is our opening balance plus income, less expenditure. Simples. And so it looks like this, folks. We've got income. You will have more lines. I've made it short to fit on the page. You'll have more rows. But we've got income, expenditure, and we tend to have three types of expenditure: project costs, overhead costs, and salary costs. And again, you'll have different categories in between. And then surplus deficit, the difference between the two. Then we have our opening balance, and then we have our closing balance. And I'll come back to the transfers later. And then we also have a column for each activity. So now you can see we have a column for our restricted grants, which I have abbreviated as Grant 1 and Grant 2, G1, G2. I've got a dedicated column for my unrestricted funds. And the golden box here in the surplus deficit row of my unrestricted funds is going to tell me if reserves are going up or down or not. And my total column, of course, is really useful. So I'm highlighting my unrestricted surplus or deficit in the year and my closing balance in yellow, because those are my golden numbers that I want to watch at all times. And so once we're happy with the format, and there's a template on the website, we can now add the numbers. And it's often easiest to start with expenditure. So we are going to budget for the full cost of the salaries. We are going to budget for the full cost of each activity. We're going to add inflation. We are going to look at how we manage grants, and starting with salary costs. The full salary cost is the gross salary we pay to the staff member plus and that should say employers' national insurance and the employer's pension contributions. Gross salary plus employers' national insurance, that's a tax that each employer pays on each staff member once they start earning enough, once they go over the threshold, plus employer's pension, and that's the full salary cost. So I see lots of budget where people have only entered the gross salary. Don't do that. Make sure you add the other costs where relevant. And if you're not sure about pensions, visit the regulator. If you're not sure about salaries, WICAS, West Yorkshire Community Accounting Service, is a good salary template. And, you know, formulas get corrupted in uploads and downloads. Just check them. And that goes for any spreadsheet that you download from our site or anywhere else. And so the employer's national insurance, it's a tax that employers pay on employee earnings over a certain threshold. And both the charge and the threshold have changed recently. And if you're not sure about the rates, download these slides and follow the link or Google employers' national insurance rates. Now there's an allowance that most small charities can claim, and it will cover up to the first 10,000 of employers' national insurance, which actually is a lot. Most small charities don't pay that much in a year, and you only get relief on what you pay up to that amount. So it's not a grant in, it's relief on what you would normally pay over. And if you're not sure, talk to your payroll provider or visit gov.uk to find out more. Now we're going to move on to activity costs, and I just want to briefly pause on full cost recovery. We hear this a lot, full cost recovery. I remember about 20 years ago or 15 years ago, it was almost hailed as this holy grail and that was going to solve everything. And it is great, full cost recovery, when we get it. But let's be clear, it is a break-even strategy. The clue is in the name. We recover the full cost. It does not give us a surplus to build reserves. So yes, we need it in the mix, but it's essential, not necessary. No, it's necessary, not sufficient. And so full cost recovery means securing funding for all the costs involved in running a project. So you can request funding for your direct project costs and a proportionate fair share of your overheads. And the National Lottery Community Fund has a fabulous guide on full cost recovery. If you haven't done percentages for a while, it will walk you through them. Have a look. Now, there are 3 types of costs we need to include when we are costing up our projects for our fundraising bids. You've got to get the direct costs. Those are the costs that are wholly incurred in the delivery of a single activity. You've got to get a fair share of shared costs. They are also direct costs and they relate to more than one activity. This is the most forgotten cost category. Support costs, aka overheads, aka back office costs, infrastructure costs, running costs, whatever you want to call them, are the costs incurred in running the organisation. Heat, light, governance, IT, HR, finance, yada yada. And so these are shared across all activities. And full cost budgeting is the direct costs in full, plus a fair share of shared costs, a fair share of support costs. And that's what we want in every single budget that we put together for every activity and grant application that we submit. And so direct costs relate wholly and fully to one activity. Think art supplies in an art project. You're doing an art therapy session. The cost of the supplies, the cost of the venue, the volunteer costs, whatever, or the therapist costs in running that session. If you don't do the session, you don't incur the costs. They're the direct costs. Shared costs are a bit rarer, but they're really important. They relate to several activities, so they're direct costs, but you can't wholly and fully attribute them to one activity. We have to share them, apportion them across all relevant activities. And the typical example for this is the CEO's salary. So if the CEO is doing frontline delivery, not governance, HR, IT, finance, not overhead work, but charitable activity work, I mean, we know all costs are charitable, but we are where we are, then that portion of their time is a direct cost. And then all the other overheads don't relate to any particular activity. They are firmly part of the organisation costs, and so we apportion those across all activities. And if you want the SORP definition of support costs, there's a link here, and it says that they are governance, general management, payroll admin, budgeting, HR, IT, etc., etc. And so when applying for grants, what we tend to do, I have found, is just put the direct costs in the direct bit, and then all of our overheads, all of our shared costs fall down into our overheads. And if the funder has capped our overhead portion of our application to say 15%, then our actual costs are greater than that sometimes, and our chances of getting full cost recovery are limited. Whereas if we can do this, group the direct and the shared costs as direct costs and not include the shared costs in our overheads, I think sometimes, not always, but it's the small wins that matter here, sometimes it can really improve our cost recovery rate. And so when we are apportioning overheads, you can't just kind of willy-nilly, randomly lump a bit on. We're supposed to have a good, reasonable basis for doing it, and that basis of apportionment should be reasonable and consistent. And the SORP gives various options. It says that you can, and the charity SORP is the accounting rule book for charities, and it says that you can use usage of resource or capacity. You can do it based on the number of people working on the activity. You can do it on the floor area if you've got a big community space, or you can do it on staff time. And I'm going to be honest, staff time for me is by far the easiest, and that's the basis I tend to use in a small charity. And so let's suppose we've got a forest school, and it's got 2 activities, and both activities incur £500 of direct costs, and the salary costs for the whole forest school are £1,000. I need a way to share those, and I'm going to do it on staff time, because for me that's generally quite simple. And if I find that 60% of the staff time is spent on activity 1 and 40% is spent on activity 2, then I'm going to apportion the costs on that basis across the 2 activities. And if I'm using staff time for salaries, I'm going to make it simple, and I'm going to use staff time, that split, that 60-40 percentage split, for the support costs for the overheads as well. And so what does that look like? Well, friends, if our project costs are £1,000, I have to allocate those directly and wholly. And I've already found out that they're £500 each. It's nice and neat, isn't it? Isn't the world wonderful when it works like that? The salary costs are £1,000. I've done the staff time and I've determined that 60% is spent on grant 1 and 40% on grant 2. Because I split that cost, £600 to £400, £600 to grant 1, £400 to grant 2. And I use that same split for the overheads because it's just so much simpler and it's fair and reasonable. And so now I have the full cost of grant 1, which is £1,700, and the full cost of grant 2, and that's £1,300. And so overall, my budget for the year at the moment is minus £3,000. Obviously, we can't stay there. So, direct costs, overhead, shared costs, happy days. Now, a note on the cost apportionment. If we are preparing accruals accounts, often there is a basis of apportionment being used in our year-end accounts. And so, don't just go and reinvent the wheel. If something's already happening in the background, you might not be aware of it. Talk to your accountant if you are proposing to change the basis of apportionment or do it for the first time. And a quick note on inflation. There is a time value to money when inflation exists. So in an inflationary period, £1 today will not be worth £1 in 10 years' time if we have inflation. It will erode the value of that £1. And this report from the pro bono, I think it is the pro bono economics team, back in when COVID came out, or when inflation started to hit, I think, did a bit of calculation and said, look, a £20 donation made in 2020 will only be worth £17.20 in 2026. Now, that was based on projections way back then and will have no doubt changed since then. But the point being that when we've got inflation, which we have, think about the time value of money. And so if at the moment your organisation needs £1,000 a year in donations, in 5 years' time, it's probably going to need more than that. And if you're not sure how to apply it or what the inflation rate to use, then go to the Office of Budget Responsibility. It's not a bad place to start. And there is the link to the pro bono economics. And don't forget, it's accumulative. So you would take that £1,000 and say you're applying 5% inflation, you would times it by 5% this year, and then whatever that is times all of that by whatever the inflation rate will be next year, and so on and so on. And I think inflation is now really important to factor in a way that it might not have been over the last 10 years. And so we now need to budget for income, and we remember that it's new money only in the year, and we do not confuse this with our opening balances, which is what I see often. And then we get into a right pickle when we've got grants, because our fundraisers are working on one budget, our finance staff working on another, and it all gets a bit of a Gordian knot. So we're going to take accounting principles across our fundraising and our finance and our governance and everything. We're going to be purist about this. So we're going to start with the worst case. We're going to start with secured income. We know we're going to get it. It's already been confirmed. And then we're going to say, okay, let's assume that grant 1 is 1k, for example, and grant 2 is 1k, and unrestricted donations are 1k. And so in this version, this charity had 3,000 in. It's plotted its secured income. It's got 3,000 in. It's plotted its committed costs. It's got 3,000 out. It's breaking even. But interestingly, when you lift up the bonnet, what we find is that not every activity is breaking even. Grant 1 is making a deficit of £700. We know that the cost is £1,700. We've just worked that out. If we've got a £1,000 grant, we're making a deficit, a loss in the period of £700. And grant 2 is making a loss of £300. Now we've received this anonymous, wonderful, passive, unsolicited 1,000 donation. There were no costs attached to that, and we're going to use that donation now to top up these grants. There is an internal subsidy from unrestricted funds across our activities. And so although we're breaking even overall, activity 1, grant 1, is making a loss. Grant 2 is making a loss. Unrestricted funds are actually making a surplus, but that surplus is now being used to mop up the deficits. And that might be perfectly fine. If you are happy to exist project by project by project, and that's a really good use of that £1,000, perfectly reasonable. If you want to build a sustainable organisation over the longer term with a bit of a rainy day fund, I'm not sure this is the most sustainable solution, if I'm honest. We've identified target reserve as 1/3 of the total expenditure, for example, in this organisation, about 4 months, and we haven't got any. It's not that sustainable. And so 3 questions that it's really helpful to ask around internal subsidies. Are they intentional? Do we know they are happening? Are we choosing to do that? And if we are we choosing to top up mission essential work and we're not topping up mission irrelevant work? Is this really the best use of this funds? And if it is, fantastic, providing it is affordable. We can do that and build and maintain reserves. And so I would argue in this charity that it's determined it needs, say, 1,000 in reserves to manage its risk. This budget is going to deliver reserves of 0. Reserves only come out of this unrestricted column, and we'll look at that more when we do the reserve session. There is no rainy day fund. And so it's surviving, certainly, but it's very vulnerable and it is not sustainable. And so this vulnerability needs managing. One risk is that if the income comes in after the expenditure goes out, the organisation will run out of cash and be insolvent. And we look at that when we look at cash flow forecasting. And so what are we aiming for? Well, we're aiming for a budget that covers the full cost of each project and maintains reserves in line with our policy. And so now let's see, okay, we've done the worst case. We can survive. It's not very comfortable. What happens if we add target income? What happens if we move on to our best case? If we add target income, this is the income we are aiming to get. It hasn't been secured. It could be really high certainty or really low certainty. And let's take a view as an organisation what we're including, and then we know the risk profile. And in this example, our worst case still has 3,000 in, 3,000 out, with no reserves at the end. Our best case we've now got target income of £1,000. So our income in is 4,000. Our income out is 300. Sorry, our expenditure out is 3,000. So we've got a £1,000 surplus overall. Fabulous. We know that's what's going on under the bonnet that is important. And so grant 1 is still making a 700 loss. Grant 2 is still making a 300 loss. But unrestricted funds now have a £2,000 surplus. We're still subsidising £1,000 to the project, but we've now got £1,000 that we're not spending that will drop into reserves. And that happens to be our target reserve. Happy days. So the worst case is not sustainable, but maybe survivable. The best case is far more likely to lead to a sustainable future, but not without risk, because we've now got £1,000 of target income. And so our budget is showing one possible version of the future. And we need to understand the implications for beneficiaries if that does not come to pass. If a different version of the future is realised, what happens? We've got to know the risks in the budget and we've got to manage the risks. And don't forget, we've got these 3 golden finance questions. What are the numbers? So what does that mean? And now what do we do? And so one of those questions we're asking is, okay, well, what is the risk? If we are aiming for a budget which covers the full cost of each project and maintains reserves in line with our policy, then our risks are insufficient income to cover costs, insufficient income to maintain reserves, timing of income, which means we can't pay bills as they fall due, which means we're insolvent, or having to close an activity or an organisation. Now, we're preparing for the worst, but we are planning for the best. So we've got to be risk aware and risk informed, and then manage it. And so it would be remiss of me not to mention that when we are thinking about financial difficulties, it is an offence to trade without being able to pay for costs that we knowingly commit to. And so we need to be confident that we are a going concern. That is an accounting concept that means we can pay bills as they fall due for a reasonable time frame. And if you're in doubt at all about what to do in financial difficulty times, visit the Charity Commission guidance on financial difficulties, CC 12. Now let's come back to our 3 golden finance questions. What are the numbers? What happens if costs are higher than we expect? What happens if income is lower? What happens if the income comes in after the expenditure goes out? So what? So what is our plan B? And now what? When would we need to enact it? We only have 3 levers: income, expenditure, and reserves. And there are massive limitations to budgeting. I love budgeting. It can get me out of the doldrums very, very quickly. I can suddenly see a path through the woods, but it is not a neat Roman road. It will wend and wind, and there will be areas I can see and areas I can't see, and it's going to be out of date almost instantly. And so we need to recognize that it's a guide that might not come to pass, and work out where the uncertainties are and vulnerabilities are within it. We need to recognize that even when we do get full cost recovery, that at best is a break-even strategy. It's the unrestricted surpluses that build reserves. And so some organisations do perpetual budgeting and revise the budget continuously as and when things change. And I'm going to be honest, I think now that's probably the way to go. Some boards are very reluctant to do that and prefer to keep a static budget and then reforecast formally every 3 to 6 months. Either way, try your best to work to an updated budget. Once it's in place, you've got to monitor it, and we do this by comparing the actuals that happen in the real world that come through, we record in our bookkeeping system, with our budget. We need a monthly finance pack. We look at the bookkeeping and the actuals in the bookkeeping session and the finance pack in the monthly management accounts. And I think it looks broadly like this. This is an example actual versus budget report where we see the actuals for each grant, the budget for each grant, and the variance. And we look at that more in the management accounting session with actual numbers in it. And so in terms of the budget now, your invitation after this is to look at your template. Does it work? Is it following the conventions? What are the numbers saying? What does that mean for your financial future? Is it all in one melting pot? Would it benefit from being separated out into restricted and unrestricted funds? Should your restricted funds be broken down into each individual grant? Is your budget taking you to a more sustainable future? Most charities can't easily, small ones, build reserves. That's okay. Knowing that helps us identify the gap and manage it. And you can do a lot with resilience building. Anticipating the future, cash flow forecasting, different scenarios, best case, worst case. You can manage a lot of risk even when you don't have reserves. But we need to know how much we have and how able we are to build them, so that we can then work out what the risk is and then start to manage it. And so the invitation is to put time in the diary each month, maybe 1 day or half a day, with half of it looking backwards, the journey that we've come, the actual versus budget and what's driving the variances, and then looking forward at the cash flow forecast, and we look at that next time. Monthly, we would invite you to review the budget and any budget variances at the end of the month. Compare the budget to actuals. Are we tracking the budget? Are we departing from it? If we're departing, what are the variances? What's driving them? Could we have foreseen them? Do we just need to get better at budgeting? Did something unexpected happen? And if nothing changes, what are we going to do? Is it okay? Do we get over the line at the end of the year, or do we need to take corrective action in between? And then annually, I think it's really helpful to be really reflective and review what went well for us last year in the budgeting. Was it on time? Did it feel really, really torturous? Was it accurate? Was there stuff we could have spotted that we didn't? How can we improve our budgeting practice next year? And so to conclude, the budget is a practical tool. It feels like a tick box exercise sometimes, but actually, if you give the budget a bit of love and a bit of care, it can really help you build sustainability. And where you can't, it really helps you identify risk, and then you can build resilience. And so, whatever our approach is, we need to be consistent. We need to review the budget in light of what's happening in the world, adjust the real world plans accordingly, accept that it's not a dusty thing that sits in the drawer, and it's something that's living and breathing. And ultimately, it's our compass through the mists ahead. And so, thank you for watching. Hope this was useful. If you want to join our mailing list for some of our free stuff, then there's a QR code. Okay, bye bye.